Good afternoon, all, and thank you for joining Samir and I, covering the POLR Capital results to the 30th of September. It's been a challenging 6 months, I think, for the industry, for everybody involved in markets. But we've had a good outcome despite the market backdrop. A strong balance sheet. Just some of the highlights for POLR Capital: a very strong balance sheet, and Samir will touch on the use of that balance sheet and the dividend. We've had good flows into our sustainable fund ranges, so emerging market STARS, which is a sustainable emerging market strategy, and a smart energy fund, which was launched last October. We've held up very well, given the bear markets affecting our core strategies, being tech and healthcare. Fund performance against peer group has been good, so 73% of our assets under management in our UCITS range and CCAV range is in the top 2 quartiles against the LIPA peers, and 87% is in the top 2 quartiles over 3 years. We've also made a lot of progress in diversifying the business, and I'll come back to that a bit later on. Turning now to the market backdrop, it's a busy chart for you all to see, but essentially what that's plotting through from December 2018 is the major indices that affect our fund ranges. So you can see the big sell-off in COVID, March 2020, the big recovery in all the indices where we were involved. So that's obviously massive liquidity stimulus into the economy. And then, of course, the realization in Q4 of 2021 that inflation has set in. Interest rates have to start rising. So you see the big sell-off through Q4 of 21, and of course the full year so far in 2022. Again, just to give you market perspective, that's pan-European flows across our industry from the Broadridge fund data. And you can see pretty much the entire year, every single month, all the way through to September, which is the latest data we've got, outflows from equity funds, in fact, outflows from bonds as well. So all asset classes affected. Year to date, European outflows, 287 billion euros, and outflows of $209 billion in the US. I think an interesting anecdote, I mean, September alone, when we had the political uncertainty here in the UK, £7.6 billion of UK domiciled funds went into outflow. So redemptions from UK domiciled funds in September alone was 7.6 billion, of which 1.3 was from UK equity funds domiciled in the UK. So you can see a massive impact on the UK funds specifically. Turning to fund performance, that's a chart we always put up. That's across our various strategies. The bars above the line is relative outperformance against benchmarks. Bars below the line is relative underperformance against benchmark. And of course, the color coding is dark blue is first quartile against the LIPA peer group. Lighter blue is second quartile, and the orange amber is third quartile. We do not have any fourth quartile performers at the moment. The one that does stand out, obviously, is UK Value Opportunities. That's our only third quartile fund strategy. It has had a really tough year. What that team does, a fantastic team running over £1 billion. They have almost 75% of their funds exposed to UK domestic small mid-cap companies, which of course has been the hardest hit. Their benchmark is the All Share Index. So you can see they don't hold the big energy companies. They don't hold the big large cap UK companies. So those are the ones that have driven the UK market. They're just not in that. They've got tremendous portfolio, but really focused on the smaller mid-cap UK domestic companies, which have really struggled in terms of valuation. But the team is upbeat, and they are awaiting the snapback in the market. We see a couple of days where the market does react, and we've started to, interestingly, see some interest in their fund again from investors topping up their UK holding. That chart really just reflects our performance against the LIPA peer group over 3 years, 5 years, and since inception. Again, same color coding. The dark blue is first quartile, light blue is second, and the amber is third quartile. Nothing in the fourth at the moment. And you can see over 5 years, for example, 87% of our AUM is in the top 2 quartiles, and since inception, 93% in the top 2 quartiles. So really, really good peer group performance. Another way of looking at it, that's performance against benchmark over the year-to-date, 3-year, 5-year, and since inception. Light blue are the percentage of funds outperforming. Dark blue is the percentage of AUM outperforming. So you can see a softer year-to-date, less than 40% of the funds and the AUM underperforming benchmark, again against a very, very difficult market backdrop. We talk a lot about capacity management at Polar Capital. You'll recall that we focus on performance for our clients, which means we capacity constrain our funds. We don't want them to get too large. There's nothing that destroys performance more than volume. So capacity is something we really do watch. And this gives you an indication as at 30 September as to what the remaining capacity is, because obviously that's the runway we've got on the existing fund strategies in terms of actually net inflows coming in. So you can see the largest is technology at the top, and that's currently at about half of its total capacity. Healthcare has quite a lot of capacity remaining. One of our real outstanding funds over the last 6 months, in fact, over the last year, has been the Global Insurance Fund. That has had absolutely outstanding performance, 22% absolute positive return year to date, relative return also very, very positive, and it's had very strong flows. So that fund has actually had the most inflows of any of our funds in this period, but it is getting close to full capacity, about another $500 million of capacity left in that fund. Emerging markets, again, a very, very strong fund for flows. We've seen a lot of demand for that particular fund, and that does have $4 billion of capacity left in it. Moving further down, I won't cover everyone, but if you go down to the sustainable thematic strategy, so that's smart energy and smart mobility. Those funds were launched in October last year, and they have significant capacity, 11 billion of capacity between the two strategies. And those have got off to a very, very good start with flows. So we're very, very pleased, albeit early days, with those funds. So in total, capacity around 66 billion pounds and remaining capacity of 47 billion pounds. The difference being is what our current AUM is. So again, we keep an eye on the capacity levels. We do beta adjust them on an annual basis. So depending on market liquidity, depending on what happens to the markets, we do adjust the capacities from time to time. Turning now to assets under management, which is the key driver of our revenues and profitability. You can see what's happened there at the trough, March 2020. Assets under management were 12.2 billion, and they recovered very, very quickly, all the way up to 23.4 billion in September 21, and then back down to 18.8 billion in September 22. So compound annual growth in AUM over that period of 12%. Fund flows in the 6 months, you can see left-hand positive bars, those are the inflow strategies. On the right-hand side were the outflow strategies, net outflow. So you can see dominated by essentially 2, technology, which really has seen clients reducing their weighting to technology and growth stocks. And of course, UK value also reducing UK equity weighting. So we haven't seen clients redeem completely. What we've seen is clients reducing their weightings to these two asset classes. If you take a slightly longer time period, it tells a slightly different story. So this is the same chart, but looking at flows over the 5-year period. So 1 October 17 to September 22. And you can see there that over that period, the largest net inflows came into our emerging market stars strategies, then technology, then healthcare, and then UK value, interestingly, and then global insurance. And where we've seen difficulty in terms of net outflows is North American fund and Japan. North American really a consequence of pressure from passives. So clients reducing their cost within their own portfolios by going passive for North American exposure. And of course, Japan has been an asset class that investors have just shunned and moved away from. So we've seen outflows from Japan over that 5-year period. Looking at it slightly differently on the next slide, that shows you each discrete year And really, what I want to show you there is 2020, which was really an extraordinary year, the initial COVID year. And you can see what happened there. The dark blue chart is technology, and that was the strategy most affected by the pandemic and COVID, positively in 2020, and of course negatively subsequently. So you can see in 2018, tech had positive flows of over 500 million. Lower 100 or so million in 2019, and then of course absolutely took off. So everybody wanted exposure to technology in 2020, and you can see inflows of 1.7 billion pounds in 2020 into tech, and then 2021 arrived, Q4 of 2021, the realization of inflation, higher interest rates, yields came down, multiples came down, and of course people took their technology weightings down again. So you can see outflows in 21 and again outflows in 2022. But you can see within our fund range, all 5 of our top 5 funds had inflows in that 2020 year. And of course that's now reversed in some of those more subsequently. This shows it slightly differently. So again, to get the message across on diversification, this is the top 5 strategies by AuM. And what this is showing is the compound annual growth in AuM over that rolling 5-year period. So 2017 through to 2022. So you can see, despite the big sell-off in tech more recently, that has grown at 21.2% compound over that 5-year period. So you can see the big ramp up to 10.7 billion in 2021, back down to 6.9 billion at the end of September. Still growing at a compound annual growth rate of 21.2. Global healthcare, 18% compound growth. Global insurance, 18.8%. Emerging market stars, albeit off a low base, because that was only launched in the summer of 2018. That's grown to well over a billion. And then UK value has had a great growth rate all the way through. And despite the sell-off in their funds in 2022, that has grown at 24.5% compound annual growth rate over that period of time. I'm now going to hand you over to Samir to run through the financial aspects of Polar Capital, and I'll come back to you on strategy a bit later on.
Thank you, Gavin. Afternoon, everyone. The key messages on the next couple of slides. For those of you that are new and are looking at Polar for the first time, the slides follow a similar format to previous years. There are a few slides where we look at the P&L, and then a few slides where we cover the balance sheet. On this first slide are the key highlights and some discussion on the P&L. And really, in terms of understanding what has happened, as Gavin mentioned earlier, the backdrop to these numbers is just really one of big market moves and a lot of challenges across global listed markets. And that has fed through into valuations and ultimately the net outflow profiles across industry. Average AuM as a consequence is down over the first half year, which feeds through to net management fee revenue ultimately. And consequently, most of the financial metrics are lower. Net management fee yield moving from 83 to 80 is not unanticipated. We normally indicate to the market that we expect fee yield to come down 1 to 2 basis points. And that's as a consequence of ongoing change in product mix. As we are building a book on EM stars and sustainable thematic, which are the newer product set for the business, we expect that to be happening at a founder share, seeding share class rates. And obviously tech has been a high margin business for a long time, part of the business. And as we see outflows, we expect that sort of 1 to 2 basis points fee yield decrease to happen. In terms of profitability, the best way to understand our P&L is that there are 3 main components of profitability. First is what we call core operating profits, and that is net management fee revenue, less direct costs for running teams, less central allocated costs for each team. And that gives you core operating profits at an individual team and strategy level, but also for the overall business. And as a consequence of AUM and management fee revenue being lower, core operating profits are lower as well. Core operating margin for this time last year was 39%, but those of you that dialed in will remember me explaining that I did not see that the margin would be that high for the full financial year, purely for one very specific reason, and that was that the Sustainable Thematic team joined us in the latter half of the year. That is a 6-person strong team. We have set up a regulated Swiss entity around that team, and we launched 2 new products. So all of the costs for that infrastructure and that support fell in the latter half of last year. Core margins for the full year were around the 35-36 mark for FY22. And if we take out the cost of the support to that team, and which is effectively an investment in the future growth of the business, core operating margins for this first half would have been around the 35% mark. So all of that really indicates good control over costs. And ultimately, even though we are investing in the future growth of the business remains highly profitable. The other key element of profitability is performance fee profits. Most of our product set do have a performance fee, and after netting off performance fee related costs, which are profit shares paid to teams, you end up with a performance fee profit to the group, and it is not unexpected for that line to be zero and at the half year mark, because most of the performance fees crystallize in our underlying funds in the latter half of each financial year. Most of our funds have a December year end, and that's when the performance fee profits crystallize. Other income reflects the mark-to-market movements on our seed portfolio, which I will explain and cover off in a little bit of detail further down the deck. But really that line represents the fair value gains and losses on our seed portfolio, net of hedging costs. So all in all of those lines of profitability combined and resulted in an adjusted total EPS for the half year of 19p. We decided to maintain the first interim dividend at 14p, and really just looking at the pipeline, which Gavin will cover on in a little bit further down the deck. Looking at the strong pipeline that we have, not only in terms of interest in our underlying funds, but potential future teams, we have great confidence in the business. We have seen such cycles before, and where we are sitting now, we were comfortable in maintaining that dividend. And when I cover the dividend in a bit more detail, I will just sort of explain sort of how we view sensitivities and the use of the balance sheet to support that dividend. Costs, to explain how our cost profile works. A large element of our cost base is variable. Staff compensation costs comprise a big chunk of our cost base, and because of the profit sharing model and arrangement that we have within the business, a lot of our cost base is variable, and as you can see, that has come down in line and as revenues have come down, allowing for the fact that there is reinvestment in the future growth of the business through the support provided to the Sustainable Thematic team, as I explained slightly earlier. Other operating costs are probably more fixed in nature and infrastructure related, and are relatively steady period on period. The one line that has jumped, unsurprisingly, is travel. As we have moved out from the sort of still closed lockdown environment in 2021, our teams have traveled more to meet with clients and reconnect, and therefore put themselves in a position to be at the forefront once sort of sentiment does change. In terms of run rate, I don't expect travel to sort of exceed too much more than where we were in a pre-pandemic environment. And for a business that has grown over the last 2 years, we have more teams and we have a larger distribution team. That isn't an unreasonable position to be in. The next couple of slides, we look at the balance sheet. A strong balance sheet, as Gavin indicated. Cash and seed investments comprise roughly 130 million at the September mark, at the half year mark. and we are seeding 8 products, and we supported a similar number this time last year as well. A number of those products are quite close to that 100 million sterling mark, which is usually when a conversation around recycling some of that seed money out and deploying it elsewhere in other seed ideas or elsewhere in the business. And that will, in all likelihood, happen with a couple of those strategies over the next 6 months. Another view of the balance sheet, a strong surplus position over regulatory capital requirements of 70 odd million. The bar chart on the left explains and shows how we allocate capital across the business, and really the framework for the use of capital remains consistent. We look to use the balance sheet to seed new product ideas, which is really the R&D side of the business, and it is a great low risk, low cost way of us growing shareholder value over the long term in terms of extending new product ideas for the existing teams. We always seek to maintain some strength on the balance sheet for future growth and to mitigate against challenges which are happening with more and more frequency. And we obviously look to return capital through our ordinary dividends to shareholders. And then finally, we do have an ongoing share buyback program that just ticks away in the background each year to the tune of roughly £10 million each year. And that is the main purpose of that program, is to offset the dilutive impact of share incentive schemes that we have in place. And finally, dividend, really, again, to give all of our shareholders some sense of how we think about the dividend. We have always said that we will look to use some of the balance sheet strength in times of stress to underpin the dividend. The last time we did this was in 2017. We paid an uncovered dividend of about 5p. And each 1p of dividend, to remind everyone, is roughly £1 million in cash outlay. So if we had to do something similar at the end of this year, that would equate to £5 million in cash outlay, and that gives you an idea, if you compare that to the cash on the balance sheet, of what sort of position the balance sheet is in, and the strength that can be deployed to underpin the dividend if need be. It was the right decision to maintain that first interim dividend at the half-year mark. A lot of our shareholders are income shareholders and investors, and therefore we are very, very mindful of that. And as we go through the remainder of the year and we get to the end of the year, we take stock again of the trading conditions of the business and the future outlook, being mindful of the strength of that balance sheet and the support that we can provide. And we take a decision on the second interim and the full year dividend at that point. And with that, I will pass back on to Gavin to cover off the strategy.
Thank you, Samir. So again, back to the strategy of growth with diversification, very, very important. We do want to grow, but we also want to diversify as much as possible to try and reduce business risk as much as possible. So that chart really just shows you the 5 largest strategies each year for the last 4 years, 4 because that's all I can get onto the page. And you can see in 2020, that big COVID year that I showed you on the previous chart, tech was 56% of our total AUM, healthcare 16%, insurance 7%, UK value 5%, and North American 4%. 2022, 2 years later, you can see tech is 37.2%, which is a much more comfortable concentration for POLR. Healthcare up at 20%, insurance at 11%, and the other funds, the total of 15 strategies, make up 20% of the total, compared to just 10% in 2020. So you can see the changing face of POLR and which 5 represent the top 5 in terms of AUM and of course profit contribution. The next slide really is to provoke some thought and to really demonstrate how POLR is positioned. Now, what this is doing is it's showing you the top 10 stocks by market cap at the end of each of these decades, and how you as an investor might position your portfolios faced with who's in that top 10 market cap companies. And very, very seldom do they make it to the next decade? There have been some exceptions, Microsoft's one, but you can see that the 1980 dominated by the US and energy. So, 1980 is all about, US companies and energy stocks. 10 years later, it was all about Japan and banks. So you might have, on the back of that decade, probably gone underweight Japan, because Japan probably is overvalued, and also underweight banks, which would have been the right thing to do at that stage. 2000, you can see there again, the US dominating the top 10, Japan's still there, but of course TMT. So that was sort of the era of TMT and the dot-com era. 2010, again, China coming to the fore, and commodities. So again, there you can see energy companies, commodities, and China coming to the fore. And of course, wind forward to October 2022, where we are right now. It's all US companies, and you can see it's technology and energy to a large extent. And of course, Berkshire Hathaway's in there as well. So, question mark, how would you position your portfolios now, given where we are? Very, very difficult question to answer. And I think what all I can say from Polar Capital is we don't know where the markets will go from here. We can't forecast or predict. But technology is here to stay. It's had tremendous capital inflows. It will continue to have that. So we are well placed with our technology fund. New areas of consumption and production in emerging markets might provide better returns going forward. So weakening dollar, a focus on the emerging markets. Again, we are well placed to capture those flows in a really, really compelling emerging market, sustainable emerging market strategy. And of course, could the demand for new energy technologies lead the energy sector back to dominance as it was in the 1980s? And that's very, very possible given what's happening with energy at the current time. And again, we're well placed with our smart energy strategy with 10 billion plus pounds of capacity. So we are well positioned to benefit from any of the above trends. We don't know which ones will dominate, but we will benefit. Again, pipeline of ideas, new teams, new managers, that's there. We continue to focus on new opportunities for Polar Capital, so we don't stand still. We are nimble. We are diversifying our regional distribution, so into Asia. We're opening an office in Singapore. Into the US, we do have a 48 mutual fund range. That's getting traction for our emerging market fund. And of course, client segments as well. So across wholesale and the institutional channel. So diversification is not just about fund diversification. It's about distribution, client domicile, and segment. And of course, all with an ESG focus. So then just to finish off and summarize, it's a boutique with a very strong culture. It's a very, very compelling home for talented fund managers who may have been in the past very happy running a single strategy boutique, but actually with increased cost of regulation and increased focus on sustainability factors, probably might find Polar a better place to run their portfolio. So we have seen a lot of approaches coming into to Polar just to investigate whether Polar would be a better home. We have significant capacity, so 46 billion pounds of capacity, which gives us a good runway as markets come back and as demand for equity funds come back in. So I'll leave that with you. Very, very strong balance sheet. That maintained the dividend. I think we look forward to markets settling down. I think my understanding, talking to a lot of our clients over this last week, has been that there are a lot of portfolios have got very high cash levels in them. People are sitting on their hands at the moment. And the sense is people want 2022 behind them, and they'll approach 2023 with fresh ideas, fresh views, and we are really looking forward to the first quarter of 2023. Thank you. And of course, any questions, please, happy to address them.
Does Polar expect to at least maintain the full year dividend compared to last year?
I think, as Samir said, a lot will depend on sentiment in Q1 of 2023. We have done so in the past. So we went uncovered for 2 years, so 16 and 17. And the business is in a far stronger position now compared to what it was then. It has a far stronger balance sheet now compared to then. So I think conditions would have to get far worse than they currently are for us to really think about cutting that dividend.
Thank you. Would you consider launching an ETF version of current funds or new ETF funds?
I'm smiling because yes, we are considering other fund vehicles for some of our strategies. That certainly is on the planning board at the moment.
And he continues, interested in your view on the ETF structure for funds more generally. Is there any more detail you can offer?
Not at this stage. We really are investigating it. It's pretty new. It's become quite a big alternative to 48 mutual funds in the US, and I'm in the US next week for the week learning more.
Okay, thank you. You talked about acquisitions of new teams. Is there a focus on hedging your technology fund with a focus on acquiring particular teams to offset that reliance?
Yes, I mean, new teams will be complementary, so they won't add to existing capability. So put it another way, we would not consider another technology team, for example. To diversify and add teams, we'd probably look for more value-oriented strategies. So POLR is still very growthy, which is why we've been quite hard hit during the sell-off of the growth stocks. So we are looking at more value-oriented. So if you look across our fund range, all our value funds perform very, very well. European Income performed well, Japan Value performed well, UK Value performed well, notwithstanding the fact that it holds small mid-caps. So you've got to look at its performance relative to what it actually does. So we would like more value-oriented managers at POLR. We want more complementary managers, and of course we try and diversify the asset classes. So things like listed real estate are interesting, listed infrastructure are interesting. People ask, are we going to be looking at private equity? The answer to that is no. It's a very, very different business, different distribution, different fundraising. That's not what we're good at. We rather want to focus on our strengths. We do have a very successful convertible bond team and bond fund, which has done very, very well this year. So we can manage fixed income. So that's an area we are looking at the moment as well. Strategic bonds, for example, on a global basis. What I can say is the funds will probably be more sector and thematic focus with a sustainable element to them, as opposed to pure regional focused funds.
Okay, thank you. And then I guess leading on from that, what percentage would you like to see technology representing going forward? Obviously, it's at 37.2 at the moment.
Yeah, I mean, there's no specific target. I've always said I'd be much more comfortable with any single team representing not more than, say, 30% of the total. So we'd want tech to grow, but to get to that sort of percentage concentration, we have to get the others to grow even faster. So I think that's the answer to the whole thing. We don't want tech to shrink. And certainly our experience has been that the rate of net outflow following that really, really difficult quarter of 2022, first quarter, the monthly rate of net outflow in tech has come right down. And in fact, we're seeing the odd day where there's some inflows. Anecdotally, when the managers are out talking to their clients and investors, increasingly investors are saying, when do you think it's time to come back into technology? Our valuations at a level now where it's becoming quite compelling to come back into technology. And those conversations are increasing. The response from the tech managers is we've had the multiple contraction as yields have gone up, multiples have come down for tech companies. That was the first big drop in valuation. What they want to see more is earnings going forward. So they want to see another quarter of earnings, probably Q1 of 2023 earnings, to see whether the earnings are going to hold up in markets, big markets around the world, which are actually struggling to grow. So I think that's the next big one. If earnings hold up, their view is tech is probably, it's a good time to come back into technology.
Thank you. Net fee income of 80 million, average AUM 20 billion. Isn't fee margin of 0.4%, not the 0.8% quoted? I think that's one for you, Samir. Can you see that?
I can't. Sorry, I cannot. No. So that would be, remember the, I think I can see what's happening there. So that would be 80 million is only for the half year, remember. So you've got to, for an annual fee margin, you've got to extrapolate that out. So the annual fee margin would be 80 basis points.
Yeah, I mean, annual revenue would be 160 million on 20 billion is your 80 basis points, correct? Yeah.
Thank you. Interest rates are rising, but at some point they will peak and then fall. Do you have any intention to address the fixed income space perhaps with bonds?
Yeah, I mean, I think I've just covered the fact that we actually are looking at fixed income at the moment and bonds. So that's definitely on the drawing board at the moment.
Well, unless anyone has any more questions, we seem to have answered everyone's thoughts so far. So I guess thank you to you both for coming along and speaking with us again. Best of luck with that changing sentiment over the next 6 months, and we look forward to a more positive outlook come next summer.
Thank you very much. Thank you all. Thank you for joining us.
Thank you everyone, and for your support. Thank you.